Good afternoon, everyone, and welcome to our weekly webinar where we will talk about what we see happening in the global economy, financial markets, and the world of wealth management, and how all of this impacts our decisions on the best courses of action for your investment strategy and financial goals. I want to thank you for taking the time out of your busy schedules to join us. This call is being recorded so that those who can't join us live can tune in when it is more convenient. I'm Scott Tomlinson, and I'm joined by my partner and colleague, Paul Tepsich, the founder of HighRock, and also joining us on the call is our financial planner, Bianca Tomlinson. We'll have a question and answer period at the end of the call, so if anyone has a question about any aspect of wealth management, we invite you to feel free to ask questions. Remember, if you have a question, it is likely that other listeners may have the same question, so please feel free to engage us. For those listening for the first time, HighRock was founded by Paul in 2010 to manage about $200 million in closed-end funds for Scotiabank, and we are registered with the Ontario Securities Commission. I joined Paul in April of this year to help build our private client business, and we're very excited to have our unique business model making an impact already. All of our new clients are coming to us because they really like our no-nonsense approach. If you like what we're doing, our approach, our service, and our expertise, feel free to recommend us to your friends, your family, and colleagues. We do have room for new clients who might be a good fit to our style of low-cost investment and wealth management. Our private client division was established to take advantage of some of the synergies that come with the funds we manage for Scotiabank. We are not brokers. We are not investment advisors or financial advisors. We are a portfolio management company who has a clear understanding of wealth management. Importantly, all of us at HighRock have our money invested in the same models as all of our clients. Whatever we do for all of us, so our interests are aligned with yours. Our fees are simple and transparent, and we fully disclose any hidden or embedded fees, and that's not the case with most investment advisors. Importantly, we have come through a cycle of above-average portfolio returns over the last 5 and 6 years, and as we enter into a period of below-average returns to bring us back to the average, it is really important to pay attention to costs. One of the reasons we are attracting new clients is our desire to keep your costs low. As well, we take our responsibility to you beyond what is required by the regulators with an independent review committee that reports directly to our clients to ensure that we are fulfilling our obligations. The first report was sent with our quarterly update and portfolio progress reports and will be sent each quarter in a similar manner. Well, fees truly matter. If you look at the impact of fees over time, it actually can be quite astounding. And please check out the graph on the right because that really tells the story. And more importantly, you have to ask yourself what you're paying for. Well, it's easy for an investment advisor or portfolio manager to get you fully invested after you sign up. However, after 6 years of above average performance for client portfolios, managing risk is now more important than ever as we enter into this lower return environment. Risk management becomes very important because we must be vigilant not to put our clients' money at greater risk in order to get higher returns. The discipline is in picking the appropriate price points for buying new assets. This is the value that HighRock adds to our client portfolios. Our ongoing efforts for the management of your portfolio strategy is to find the best possible returns while simultaneously providing the least amount of risk in doing so. Naturally, this is done in the context of each of our clients' specific goals and their tolerance for risk. Our research shows that a globally diversified and balanced 60% equity, 40% fixed income model can significantly reduce risk and still achieve an annualized return of between 7 and 8% over a multiple year period. This is what we consider to be the optimal portfolio. Now, rebalancing on a regular basis is crucial. Different asset classes will outperform or underperform at different times in a market cycle. Selling outperforming assets and buying underperforming assets will continually add to value and return. Underperforming assets will eventually return to better performance while outperforming assets will ultimately underperform. This is how profitability is realized and the new cash is reinvested. Our strict adherence to goals-oriented investing, structured models, protecting client capital, regular rebalancing, in-depth research, fiduciary responsibility, and high levels of client service have permitted us to add the slogan of disciplined investing to our brand. So you can look for this new slogan to be displayed on our website in the coming time. Well, at High Rock, we have three models with which to create balance and diversification. Many of you already know this, but I'll just quickly run through. We have a fixed income model with bonds, both government and investment-grade corporate bonds. We also have a small percentage of high-yield bonds, and we look at preferred shares here as well. We have a global equity portfolio that focuses on diversification across thousands of companies in multiple economic sectors and across many geographic locations. And as well, we also have a model that focuses on Canadian to small to mid-sized companies where we have a great deal of familiarity and do deep levels of research. Now, this is an active or tactical model intended to obtain better than average growth. For our clients, we use these models to create portfolio strategies that are in keeping with your desired goals. Well, each week we look at our broad themes for 2015, and this is probably not new to some, but if you're listening for the first time, this is how we have looked at our themes for 2015. Our overriding theme this year is to expect surprises, and it's not been a dull year so far. We don't expect anything less as we go forward. Oil prices began the year making multi-year lows, and the repercussions continue. After a period of stability in the April through June period, oil prices broke down a few weeks ago with the Iranian nuclear accord, and now are making new lows as supply continues to outweigh demand. In fact, today OPEC reported that supplies had risen to the highest level in more than 3 years. Well, this is impacting not just oil, but all commodity prices are falling, which we think is a pretty important situation that's evolving, and I'll talk a little bit more about that further along in the presentation today. But definitely, it's impacting the Canadian economy, and of course, the global perception of the Canadian economy is that Canada is still very much a resource-based economy. That perception may be a little outdated, but nonetheless, it is having its impact, and certainly the results for the first 5 months of this year show that the Canadian economy is declining. And one of our themes this year is that central bankers do not like volatility, and especially in financial markets, because it erodes confidence, and when they're not confident, businesses do not invest and consumers don't spend. In 2011, Mario Draghi, the head of the European Central Bank, said that he would do whatever it takes to keep the euro, and he has. Earlier this year, he embarked on a significant bond buying program with an extraordinary monetary policy of quantitative easing, and that was essentially to try and boost the euro economy, while at the same time helping to lower the value of the euro in order to facilitate the growth of exports in Europe. Well, certainly we've had a situation in Canada evolving where we've seen an unexpected slowing, significant slowing. Nobody called for a recession at the beginning of the year. So the Bank of Canada has responded by dropping the bank rate twice, actually cutting it by a full half a percentage point in the last few months. The Canadian dollar has been impacted significantly, and it suggested that there may be a continued trend to lower. We've had to be wary of this, and certainly we have to try to have a portion of our client portfolios held in U.S. dollars and also in the international companies, which provides diversity and also reduces the potential for volatility. As we're all aware, we are entering into an election period in Canada, and the current state of the polling tells us that it's going to be a close call between, certainly at the moment, between the NDP and the ruling Conservatives. Certainly, the NDP, if they do get in, that will create a lot of unknown, and in financial markets don't like unknowns, and it could potentially have an impact, and certainly may have an impact on the Canadian dollar. We have to be on guard for this. Currently, the Canadian dollar is at the lowest level since the Great Recession, and it's not expected that the Canadian dollar will, the lower Canadian dollar will enable the Canadian economy to jump back anytime soon. There is a lag time between when a weaker currency starts to impact the export economy. So with the global economy struggling at the moment, demand for Canadian goods is reduced. So especially in manufacturing commodity-based exports, we'll have to wait to see when this will all start to be beneficial. But at the moment, certainly it's taking some time. Another of our themes is that it was widely hoped that the U.S. economy would improve significantly in the second half of 2015, and by virtue of that, help to propel the global economy to a better economic performance. At the moment, early readings on third quarter economic growth in the U.S. Have not been showing this. While the U.S. economy struggled in the first half, we are now seeing signs that the early data, as I said, from manufacturing, not as promising as had been expected. Employment growth data in the U.S. is starting to trend lower. The participation rate at the lowest level since 1997. Neither of these things positive. Labor market conditions index is slipping in the U.S. And productivity is falling. All of these things have to be concern for the Federal Reserve, and we'll talk a little bit about that in just a second. But I'm going to continue to hammer on this sub-theme that we have added a few months ago that we think needs to be part of the conversation, and that's that baby boomers, the former big spenders, are now entering retirement, and their consumption habits are changing. And millennials, the largest cohort now, the age group that are in their 20s and 30s, definitely have less money to spend and certainly have different consumption priorities. So retail sales are falling. Consumer confidence slipped in July, and as the U.S. consumer is 2/3 of the economy in the U.S., and we think this is not just a seasonal factor, but in fact may be a structural adjustment that could potentially hold back the U.S. economy in the second half of 2015 and perhaps even beyond. As for other parts of the global economy, we see Euro area economic sentiment turning lower. Retail sales have actually turned down recently. And of course, falling commodity prices have impacted Chinese exports, which unexpectedly fell by about 8.3% in July and prompted the Chinese Central Bank to devalue the yuan by 2% today, fueling more fears of lower global economic growth. And as a result, if anybody's looked at today's markets, you'll see the impact. What is next for the U.S. Federal Reserve? Well, it had been expected that they would raise rates by 0.25% in September, but a lot of that sentiment is shifting. Certainly, we are now in a camp that believe that this could be pushed back because the U.S. economy is not evolving as the Fed had projected, and the global economy continues to show signs of slowing. So the Fed, and remember, the Fed's track record on the economy has tended to be somewhat more optimistic than what reality has shown. So that's certainly something we're monitoring. And of course, we are very concerned about what's going on in the world as far as prices are concerned. Do we have deflation? Certainly, the big scare earlier in the year, and a lot of that happened in around April when we saw bond markets hit their low yields. That scare seems to be somewhat alleviated, but inflation continues to be precariously below most central bankers' targets, and recent declines in commodity prices are definitely giving some pause for concern. Another reason why the Federal Reserve may think twice about raising interest rates in September. Inflation remains well below their Fed's target of 2% for the core personal consumption expenditures index, and last Thursday the Bank of England voted to hold interest rates at current levels because recent inflation data had pointed to lower core inflation, and that became a concern for the Bank of England. And this has been impacting bond markets recently, and we know that bond markets lead other financial markets, and certainly deflationary worries have, as I said, hit bond markets in April, but bond markets rebounded with a significant volatility from late April to mid-June, and then bond yields came down again in July as the Greek situation reached its crescendo. And now bond markets are reassessing the global economic horizon, and the deflation or inflation question is definitely front and center. So there's interest rate risk involved here. That's the future direction of interest rates and how they will affect fixed income assets. But we also have to look at the duration risk, and this is the assessment of what part of the yield curve will necessarily be more impacted. Now, the yield curve is the rate of interest across the maturity spectrum from floating rates in the short term to 30-year rates and beyond in the long term. Looking at the Canadian government bond yield curve, what's it telling us? Well, in the short end, there is the potential built in for, partially built in, I should say, for a Bank of Canada rate cut. And the struggling Canadian economy and the current levels of inflation have pushed 10-year yields back down to their April 20 lows. So as the Canadian economy struggles, we have to be monitoring this and what's happening. Now, we did add to our fixed income model. We added 10-year Canadian government bonds back in May at higher yields and lower prices. So that trade has actually worked out quite well for our clients. Watching the U.S. yield curve, now only partially pricing in a September rate increase, and as I said, some analysts are now, and us included, expecting that this rate increase could potentially be pushed back to December, although Federal Reserve Chairman Janet Yellen has said that in all likelihood there will be a 0.25% increase at some point this year. In the UK, with the despite the Bank of England Governor Carney's warnings of higher rates in the future, the UK yield curve has shifted lower subsequent to last Thursday's announcement when the Bank of England did not raise interest rates. Not a lot has changed in German yields, still negative out to 5 years, and again, this is a clear sign that deflation potential is on the minds of short-term bond investors, and obviously that is something that we're taking note of. Well, we're now at the end of second quarter earnings season. Companies have reported in aggregate year-over-year declines in earnings of 1%, and corporate revenues have fallen by about 3%. So analysts are not currently projecting earnings growth to return until the fourth quarter now of 2015, and revenue growth not to return until the first quarter of 2016. Analysts are calling for a decline of 3.6% in third quarter earnings, but growth in the fourth quarter of somewhere in the vicinity of 2.4%. In terms of revenue, analysts are currently projecting a decline of 3% in third quarter earnings, revenues, and a decline of just under 1% in the fourth quarter, but growth returning in Q1 of 2016. Now, for all of 2015, analysts are projecting earnings to grow by approximately 1.2%, but revenues to decline by 1.7%. Now, if you notice, the S&P 500 is actually almost only up ever so slightly, maybe just 1% on the year so far. Well, that being the case, current forward price earnings ratio for 12 months is 16.5%. We talked about this because we're looking for where there's value. Certainly the average for 5 years is 13.9. The 10-year average is 14.1. So again, we think this means that stocks are expensive, but also we believe share prices are expensive relative to company valuations, and simply because the demand factors where share buybacks have reduced the supply of equities out there. So investors looking for better returns have increased their exposure to risk, and there is less supply and greater demand for equities. Now, here's an interesting thing to note, taken from this morning's Wall Street Journal, but global mergers and acquisition activity, which set a record in 2007, is poised to set, at this point, a new record for 2015. Well, we all know what happened after 2007 in the equity markets. When we look back to get a little perspective, we can have a peek and see what's happened with the S&P 500. So interestingly, it looks like anything above 1,600 at this point in time in the S&P 500 is somewhat more expensive. So we see many reasons to be cautious, certainly from the fundamentals, but if the technical picture turns negative and certainly more sellers emerge, there's lots of room for a significant market correction, and a 20% correction takes us back to the 1,600 to 1,700 on the S&P 500. So we think that's quite likely where value would be considered more or less neutral. So how are we positioning our portfolio models based on our assessment of the current environment? In our fixed income portfolios, we've been listening to the pundits speak. Former Federal Reserve Chairman Alan Greenspan, the predecessor to Ben Bernanke, he coined the late 1990s stock market tech bubble as irrationally exuberant. Yesterday, he suggested that the bond market might be in a bubble. We'll take that into consideration because we certainly want to avoid buying assets that are bubbly, but it's certainly in our nature to be cautious, and we also have to weigh that against the potential for further deflation, certainly from what commodity prices are doing in the market. So all of these things give us pause. Bond market investors' biggest fears are certainly, especially in the long-term rates, the inflation. If inflation reemerges, it definitely hurts their return. But negative yields, as I explained in Europe right now, are telling us that investors are more afraid of deflation at the moment. So we want to add bonds, but certainly only when we think the time is appropriate. And so our job is to monitor developments in these markets to determine the right course of action for our client portfolios. Last week we discussed the benefits of better risk-adjusted returns that are offered in the Canadian high-yield bond asset class. Certainly this is included as part of our fixed income strategy. The low correlation to other asset classes gives our clients an added dimension of diversification for their portfolios. As well, historically, if and when interest rates go up, these bonds are not impacted negatively. Usually higher interest rates result from strength in the economy, and a strong economy can benefit the balance sheets of the high-yield sector, driving their bond prices higher. There are some opportunities developing, especially in the world of commodity markets, and it's an asset class that we're monitoring very closely at the moment. Preferred shares are another of our fixed income asset classes and have suffered on the back of lower interest rates and the fact that many of the higher yielding issues have been matured and replaced by lower yielding issues. The rate reset preferred share issues are replacing the once popular and higher yielding perpetual preferred shares. The lower return environment has impacted this asset class significantly, but there are still some higher yield preferreds available, and we've been able to manage to pick up a few of these, what's left in the world of the perpetual preferreds for our clients. And it's because some of these prices and yields are definitely looking attractive. Well, we're now officially adding the theme that we are in, a low return environment, to our list for 2015. Low economic growth, low sales growth, low earnings growth, low productivity growth, low wage growth, and low inflation are all going to contribute to lower interest rates and lower investment returns in the foreseeable future. So this is a theme that we think has to be part of the thought process. In our global equity model, volatility has eased considerably since the Greek situation was resolved, but the fundamentals and now the technical aspects of equity markets leave us with continued concern about putting additional cash to work in the current environment. This is our disciplined approach at work. Despite today's jump, volatility has remained at or about its longer-term averages. So we're not seeing anything alarming at the moment as far as volatility is concerned, but we are watching markets closely. The S&P 500 has been struggling to hold the uptrend from last October, and there has been very few positive catalysts to support better prices. We see potential buying support at the 1980 to 2000 levels if we break below where we are now, and then certainly further buying support at last October's lows near the 1820 level. The TSX bounced off its lows, but the downtrend remains intact, and prices generally look to be heading lower at the moment. Japanese stocks tested highs on Monday, but slipped today. That's one market that seems to defy gravity, but as we talked about a while back, the Japanese central bank has the ability to buy equities when they feel they should, and that artificially supports that market. So something that we have to keep in mind at all times. UK equities did find some buying support with as the anticipated interest rate increase failed to materialize last week, but they've definitely not been able to break out of the recent downtrend. Euro stocks have been unable to break out of their recent downtrend. Lots of volatility in Australia, but prices are being driven by commodity prices, and that downtrend is definitely continuing. As for China and other emerging markets, the trend remains down, although China has been finding some buying support recently. But emerging markets continue to suffer. We should mention that we are underweight emerging markets across our model, our international model there, and certainly will look to find opportunity, but we'll wait for the selling momentum to decrease here. Okay, well, all of this, as I said, gives us reason to remain cautious in the equity markets, looking for better buying opportunities further down the road when we think that some of these downtrends are resolving themselves. But we also have a Canadian growth equity model, and Paul, I just bring in your expertise to give us your thoughts. I know there's been a lot of earnings coming out that you've been following, and if there's any updates, feel free to go ahead.
Thanks, Scott. Yeah, there are certainly, we're in earnings season here for the second quarter, so it's extremely busy. And I would probably echo what I said last week. And there are, it seems to me, companies have had a pretty tough second quarter. Maybe that kind of plays into the overall Canadian economy and all the talk and chatter about Canada effectively being in a recessionary period. But there are still some companies that have reported okay. And I still have some more to go through, in fact, this afternoon and early evening. But we do have our watch list and companies that we track, we do research on, and we're following. And I'll give you an example. Some we're being extremely cautious is the bottom line. Some I'm looking at, one in particular right now, it kind of looks to me like it even broke down where I thought it might stop. So as per our new motto, we're going to be disciplined here as we are in all of our models, and just continue to watch things and be extra cautious and careful because the markets are extremely volatile.
Thanks, Paul. Well, we've pretty much gone 3 minutes over our time today, so I will open it up to questions. Please feel free to ask now. Okay, well, it doesn't sound like we have any questions, so I will remind you that if you are listening to the recorded version and you do have a question, would like to email us, we'd be more than happy for you to send your questions to us, and we'll make sure we get them answered on our next call. But that's it for another week. Thanks for taking the time to tune in. Have a great week, a wonderful weekend, and we shall return with another webinar next Tuesday. This is Scott Tomlinson signing off.